We're funded by government to support SMEs in Wales. I sit in the Angel Network, and we mainly deal with early stage startups looking for that equity investment. So today I'm here just to talk about how to get angel investing, who they are, and how to get yourself ready. So I'm just going to click on got it for the recording and move down to the next slide. So yeah, and so hopefully by the end of this presentation, you have a bit more idea of what angel investing is and what you need to do if you want to go down the route of raising angel investment. So first question I ask people, if you can just take 30 seconds, is what's the end game for you? Where, if you are at that startup stage, what does the end look like? Is it that you're going to build a unicorn? You hope to make yourself 10 million in wealth? What does success look like to you? And then once you've had a chance to think about what that end game looks like, you've got to go build back from that really and think about what key milestones you need to achieve to get there. Most of our angels are looking to invest in you, and it's a journey. So what key milestones are you going to be coming across? And you can try and tie that in with the funding journeys rounds that you're going to have to make that happen. So all of a sudden you're not looking at, I'm just raising 200k in this round. You're looking at, this is what the funding journey looks like. This is the potential exit. And if you can plan that out as much as possible, you'll give investors more confidence that you actually appreciate, you know, the tough journey that it is. And with that in mind, a bit of fun is you can have a bit of an analogy for this for startups. So, you know, what type of startup do you want to run? Some, you know, some companies are happy raising lots of venture capital investment. Some are more lean, and some have got less ambitious growth plans. So if you can start identifying in terms of what your strategy is, it will help you as you go along in your journey. So that's just a bit of reference there you might want to have a look at later. Interestingly, angel investors aren't so bothered about unicorn companies. They're higher risk, and quite often the VCs can come in and put terms in. And I've met angel investors that haven't actually had a gain from a company they invested in that went on to be a unicorn. So it's not always aiming for that, that status. And before you go on the journey, you know, it's not easy. It's a bit of a roller coaster ride. Sometimes you'll have white knuckles, sometimes you'll be exhilarated, and you need to look after yourself. So appreciate this is going to be a lot of up and downs, and make sure you've got someone looking after you outside of the company, you know, some kind of mentor that you can go to for anything. And make sure you're aware of the tax breaks. In the UK, we're really lucky. We're one of the top 3 countries in the world that offer these sort of tax break to investors. HMRC, the government recognise high risk in investing in startups. So they reward that by giving these tax breaks. And to give it, if you're not aware of them, to give a very short summary, if your company is eligible for SEIS and your investor is a high rate taxpayer, they could actually only stand to lose 28 pence in the pound that they invest in you. So although these aren't drivers of investment, they certainly help with the risk profile. So if you're not aware of them, make sure you find out a bit more about those. 2 things to be aware of is there's eligible for and there's advanced assurance. So eligible for means you know you're eligible for these breaks, and you're planning for those in your pitch. And advanced assurance means actually you've gone that stage further, you've been in communication with HMRC, you've had a certificate back for them saying, yes, you are qualified for these tax breaks. Normally, you wouldn't bother doing that until you're in conversations with investors, because they ask you to name an investor on the form. But normally at the end of the tax year, things can get busy and investors want to know, get more keen to know immediately about that advanced assurance. So given the time of year we're at, it's quite it's quite advantageous actually to move that step on. And then valuation. So, you know, valuation is probably the trickiest bit of my job in terms of making sure a deal goes over the line. You know, you have the 2 different mindsets. You'll have founders like yourself that see the growth potential, the huge market, and that you're only taking maybe 2%. Investors will come from a totally different viewpoint in that we're going to put a value on what we see right now, and that'll be the value of the team, the value of the IP, the value of traction you've made. They'll have their own scorecard that they are working towards. So you've got to strike a balance between them and you in terms of what you both feel comfortable with. There are red flags. Obviously, your first seed round, if you're giving away more than 25%, you definitely see that as a red flag. And most good investors wouldn't want to be taking too much equity because they want you to be keen and have enough skin in the game to go through the highs and lows that they know you're going to go through. If you want to learn a bit more about investors thinking, David Burkus, that's the method that started all the scorecard methods off, and most investors have their own version of this now. And it just gives you a bit more insight into what they think about. I suppose you're in a competitive landscape. There's lots of companies out there seeking investment that are all saying they're high growth, that are all saying they're only taking a small percentage of the market. So that's not unique to investors investing in startups. What's unique to them is what you have right here and now, and that's what you want to make sure you show you've got value on. So that's making sure you're ready for the journey you're about to go on. We'll just cover now a bit more about knowing a bit more about angel investors. So a lot of people think that they're these ultra wealthy, untouchable investors, and they're very far and few between. When the reality is actually they can be all around you. The best angel investors, like the top tier, really is the entrepreneurs that have been there, done it, and sold their businesses. They can be great mentors. They've got loads of advice, and they're really passionate about giving back. But you also get C-suites, all the top CEOs, CFOs, CMOs of the top companies. They're very successful in their own right. They've got the wealth in their own right. And, they're probably looking to do something a bit more interesting aside of their day job. So they often get involved, as do the professional services. So your accountants, your lawyers, they all like what they're seeing, and they get involved. And often the industry experts that understand the innovation can see there's a lot of potential. So, one thing we talk about is utilizing your network, because you may find some investors through your friends, family, and wider business network. There is just an air of caution with that, in that investing in startups is high risk. You're not FCA regulated, so anybody you speak to needs to self-certify as a sophisticated investor. So they can talk to us. You can go online and find self-certification forms and make sure they sign that. Then, in the worst case scenario, if your company does go under and these investors come back to you and they say, you missold me, I don't feel comfortable with, I never realized the risks, you've got that form as comfort to say, look, you declared, you agreed, you understood what this proposition was. And how do they invest? So most investors, over 80% of them in the UK and probably around the world now, choose to build a portfolio and syndicate. So that means they're working in small groups and they're coming together to invest. And that has advantages for the investors as well as the companies. And what it means is the investors can learn and grow with each other, but it means also that the company, which is often going to need follow-on capital, have got more investors to go back to, and you've got more smart investors in there to draw upon when you're trying to utilize their expertise or tap into their networks. And we've also got lead investors that are in our angels can invest alongside. So you've got the Development Bank of Wales, which a lot of our investors know and like investing alongside. And we've also got an angel CoFund where we have lead investors that are experienced, that bring other investors in that shadow and learn from them. So I suppose the big point there is, if you're new to learning about angel investing, don't expect to get the whole amount from one investor, because those investors are becoming less and less more common. So what is an angel investor looking for? This is a real general guidance, because it's private individuals' own money and they will do what they like, and they're often unpredictable. So even though I may think I know what will get investment, I can be surprised at what we see gets activity. But as a general rule, first and foremost, it is the team. It's all about execution over innovation. You know, they'd rather have a worse idea and a better team than a great idea and a bad team. So it's people, people, people. And you'll hear that wherever you go. Everybody seems to say the same. That can be tricky for you in the early days because obviously you won't have built a team. So think about, if you can, who you think you're going to draw in and what your recruitment strategy is. So the more you can build around that, the more investors can get comfortable with, you've thought about it, oh, and you've got these people that you're going to bring on board that look credible and I think they'd be great as a team, and you can help build that picture for the investors. Secondly is innovation. Investors tend not to invest in small, slow growth businesses, lifestyle businesses. They're looking for some kind of high growth. So that is IP or something that's got some defensibility around it or early mover in the market, so that then you can ultimately achieve that high growth. And they need that high growth potential because of the risk reward ratio that is set. You know, if you look at the stats, if an investor's got a portfolio of about 10 companies, it's probably only 2 of those 10 companies that are going to deliver the return for all of their investments. So they need all of them to be aiming high for at least some of them to deliver for the rest. And when do they invest? So the sweet spot for the most investors is validation. So have you got a prototype? Have you got potential customers using that prototype, saying they like it? They pay X amount and that makes it commercially viable for you. The more you can prove that, and you know, it doesn't have to be an expensive prototype and it doesn't have to be lots of paying customers, but they do have to get a feel for that you're onto something and you've got that research and work ready for them. And then the next stage is, if you feel you're at that stage, is getting your documents ready. So there's a lot of talk about business plans and cash flows and whether investors want them or not. Our investors, I would say, definitely want a business plan. But, you know, we know these are agile and always fast moving. So don't do pages and pages and pages. Try and keep it slim and appendicize what you can and take out what you need. And with the financials, they're probably just as important, because although cash flow forecasts are really hard to predict, it does help investors work out where your assumptions are coming from, and how you're controlling your costs and what you're spending your money on. And then finally, it's exit. So we've been going for 4 years and we've spoken to angel investors outside of Wales, those that have been there, done it for decades and had some good returns. And they tell us, you know, the companies that have been most successful are the ones that have had an eye on exit from day one. And that goes in line with your journey, your funding journey, really. If you can work out what milestones you need to achieve for the VCs, as well as what acquirers might want you to look like to sell, you're more likely to succeed because you are focused and you're less likely to run out of money doing things that aren't going to add value. And how do you find them? So yeah, you know, they do often go under the radar. We've got a network now of about 270 individuals. Some of those are early stage SEIS funds that we'll introduce to you for free, just to try and get more investment pointing at Wales. Again, like I said earlier, there will be some potentially in your own network if you're happy to speak to them. And there's multiple platforms and angel groups out there. So, you know, I would say about 30% of what goes on our platform gets funded. It's tough. But then when they do, it tends to be syndicates with a lot of value to add. And we don't charge for that. So once you've got your investment documents ready, it's worth exploring with us, because then you're ready to go to other networks too. We're members of the UK BAA. So if you get a smart investor validating your opportunity, as well as our network of local investors, mainly local, we can also get you on that platform for free if we know who that investor is. And they've got a network of about 3,000 investors and early stage funders that we can then promote you to as well. Some companies are doing a hybrid approach with crowdfunding these days, and that can work really well. What I would say is there's a process you need to consider. Do you go to the crowd first or do you go to angels first? So my point of view would be go to angels first, agree a valuation with them, get them on board for some of the raise, and then go to the crowd platforms to close. If you try and do it the reverse, or say you do a crowdfunding round first, and then 18 months later you're coming back for an angel round, It's probably going to be more harder for you to be successful because you won't have got the smart money through the door, and your valuation's probably been inflated by unsophisticated investors. So just give that a bit of thought. So pitching to investors, you know, we have some guidance on that I can share afterwards, but basically you've got it. It's all about storytelling. You know, there will be facts and figures in there that are compelling that you need to get across, but don't overwhelm the investors with data. Keep it high level. Keep teasing them. And remember, what they're trying to think about is, do they want to go on this journey with you? You know, they're going to be on this journey with you for many, many years. So have they bought into that journey that you've just sold them? And remember, you know, as an entrepreneur, you are going to be wearing many hats. You know, you're going to be the CEO, the CFO, you know, all those different roles you have to play. One of them is going to be a sales role. You know, you're going to have to, you know, learn how to build investor relations and follow up, you know. So the moment you decide you're going to be speaking to investors, you need to be keeping them warm, keeping them updated. And it's almost a full-time job and you're still running your business. So have an approach that you can streamline, and you've got these one pages you can keep investors updated with. And remember, not all investors will be from your sector. So, you know, dumb it down. You know, it's the NAN test. You know, can she understand it? You know, you'll have some of the smart investors in there, but some investors will be smart from other sectors and add value in other reasons, but they won't necessarily get your technology. So sometimes it helps to use a case study. So as a customer, how are you improving their journey by using your product? So once you've started pitching to investors, you'll hopefully then start having some conversations. And then, you know, it's that nervous point of like, actually, how do I know if I've got the right investor for my business? And, you know, it is tough. It's like a marriage. It's more legally binding than a marriage. So you've got to make sure you're comfortable with the relationship. Do your homework. Have they invested in other companies that you can go and speak to? And then make sure you're aligned is really important. So when I talk about journey to exit, you know, if you've sold the dream of, you know, a high growth business and then you turn into not such a high growth business, you know, you're then not really aligned with your investors, and there could be conflict there. So if you're building that relationship with them and you're keeping them updated, and, you know, the high growth takes longer and there's ups and downs, that's expected. But as long as you're both still on the same journey and still agreeing what the best approach is, then you'll have a healthier relationship. And agree they're all post investments. Some of them you may want on the board. Some of them might ask to be board observers or might want just information rights. But keep them involved, keep them engaged, because ultimately you'll need to go back to them for a second round. And the more you update them, the more likely are they to follow on and support you. I'm not going to go into too much detail of the documents because that's for another session with a professional, but there are a huge amount of documents that you then have to get your head around. And co-founder agreements can be important for you as well as the investors, in terms of if your co-founder leaves, they could potentially take a while off shares from the business, and that really hinders new equity investors coming in, because anybody who's got shares in an early stage business needs to be there, skin in the game, helping the company grow. So if a co-founder has walked away, you know, they've really diluted the value they're going to offer the company. Term sheets, you often get issued these by investors, but you can issue these to investors as well and set the scene. And then you've got your shareholders agreements, articles of association, and your non-disclosures. They're all set by your legal representatives. And I can't stress enough, make sure you read them. You know, again, in terms of investor relations, make sure you understand the consents of investors and the rights they have, because you may, if you're not clear on them, you may make decisions without their consent that you didn't realize actually you needed permissions for. So, you know what you're going into. And then advance, you know, quite often you've got rolling rounds now. It's not get all the money on one date and close the round. Sometimes you do advanced subscription agreements so people can come in early, and deeds of adherence so people can come in after. So get familiar with what these documents look like and what you need to understand. And then post-investment, there's still stuff to do. You know, you've got to think about what KPIs you're working towards. You know, that first seed round is the most critical in terms of your success. If it's hard enough getting the first round, but once you've got that first round, if you don't achieve what you said you would achieve, you may not land up getting follow-on investment. And some investors will say, investors in round 2 will say, well, are the existing investors following on? And if they're not, because you haven't set KPIs or you haven't got anywhere near them, then the new investors are less likely to come on board too. So be focused and manage those investor relations. And again, really look after yourself. You will be wearing these multiple hats. There will be ups and downs. It will be time consuming and you'll be pushed and pulled in all sorts of directions. So look after yourself. And in terms of investor relations, you will start needing to do board meetings at some point, sometimes straight away. And depending on the dynamics of your investors and the management team, even in the early days, you might be thinking about getting a chairperson on board to support the company as a whole. And don't forget that after you've had the money off the investors, you've got to give them their tax certificates. I did hear a story last year from a company who forgot to apply, didn't apply correctly for the tax breaks. And then because he didn't want to damage investor relations, he gave them more shares to compensate for the tax breaks they've lost. So it is a fairly straightforward process, but there are some common errors, and part of the process is automatically to get those certificates issued. So I'll tell you a bit about us now and how we can support you. Obviously, we've been in a pandemic for the last 2 years, and that's been tricky. At the beginning, we didn't know how it was going to affect investing, but we've actually been pretty busy. We've had a lot of positives. You haven't got those geographical barriers when you go online. So when we've done, for example, Meet the Coffee meets for companies that we showcase, more people have come to those initial meetings than the initial investor that asked for that meeting to happen. So you can get more people coming to talk to you. But, ultimately, we haven't been able to do those live pitches, which is all about trust and relationships. So, ideally, in an ideal world, we will showcase investors digitally, but also we'll get back to doing live events. But we have been busy, and I think a lot of that is to do with, a lot of our investors are new because we're only 4 years in, and they haven't got large portfolios they've had to rush in and support. So we have still seen deals being done. And to try and bring it to life a bit, here's a couple of deals that we've done this year. So as I said, syndication is what most investors want to do. And I'll talk through Concentric Health a little bit there because that was a good example of the process we run. So that had a syndicate of 24 investors investing $500,000 with our angel CoFund. So the founder and the lead investor there, Ed, met. We put Ed on our digital platform, Concentric Health. We then did a Meet the Founders webinar where the investors got a chance to meet DAF and the lead investor that was interested in the deal. We had about 8 investors on that call, all speaking to the founder, sense checking with each other, working out who liked what, who was concerned about other areas, people that had experience in corporate finance in medtech, others that had CTO experience. And then following that call, it led to further discussions, further due diligence, conversations around being aligned to the end strategy, to the deal then being closed at $500,000. And we're seeing more and more of those deals where we've got less deals, but more investors coming in for the round. So I've talked a little bit about our process there. So if I go through it in a bit more detail now, so when you come to us, I will email you what we need to showcase you. And we have a digital platform. We use Delio based in Wales for our platform. And once we've got your elevator pitch, your pitch deck, ideally a video pitch because, it's worked well in the pandemic and it really helps investors get a feel for who you are. And like I said, the business plan and the cash flow. Once we're happy we've got that information, we can get you live on our platform. I can then meet with you or share my screen online with you and show you what your deal looks like on our platform. And if you're happy with that, we can then hit go live and then we can get you live there alongside all the other opportunities. Your elevator pitch will be emailed to all of our networks, so that's how our investors keep up to date. Plus, we have a monthly newsletter that all the new deals go in and are captured again for investors to review. What can happen then, and what happened with the likes of Concentric Health, a couple of investors say, oh, I like that, is anybody else looking at it? And I'll say, yes, we've spoken to the company. Next Monday, we're having a coffee meet online. Join us, I'll send you the link. And then again, from there, that's where the deal starts, and conversations hopefully then lead to a deal being done. If not, there's feedback, and you do have to be willing to have critical feedback. You know, it's not always what you want to hear or agree with. And it's not always right. Investors don't know everything. Sometimes their opinion is coming from a different angle that isn't relevant, but just appreciate they've given their time to give you some feedback. And we don't charge you for this. So again, it's a good way to test your pitch as you're starting your journey, and to see what investors come forward, and if any of our SEIS funds come forward too. Companies are live on that platform for 3 months, and then we have to take them off, because we can't keep it static. But if you come back to us in 6 to 9, 12 months saying we've done something dramatic, the opportunity looks different, then we can look to review it and put it back on the platform. But we're not constantly reviewing them and constantly re-putting companies on the platform, because it just looks tired and it doesn't give the right message. And the final thoughts really on that is, it is competitive. There's not huge amounts of angels out there. So you do have to stand out, make it compelling, make it easy for investors to understand, and make sure you've given that teaser in your elevator pitch for them to want to meet you and find out more. And yeah, you never know who is going to be an angel. So be ready to pitch to anyone. So that's my slides. I'm more than happy to go to Q&A now. I appreciate I ran through that quickly, and there might be some questions. I see there's a chat box, so I don't know, Liz, if you've had a look in that.
Yeah, there's a few questions come up. I just want to have a look. We go from, I think Richard's question was answered there by Alison, I guess. Andrew has got a question there. I guess there's a fixed co-investor fund from DVW. How much is this, and over what period is this intended?
Yeah, so there's two things to clarify there. So we've got an angel co-fund in Angel Invest Wales, an £8 million co-fund that we can invest alongside lead experience. These are experienced investors we've pre-approved and said, yeah, if you go out and get inexperienced shadowing you, we'll invest alongside you. We can invest in any one company alongside them up to 250k. So it can be tranched. So it might be like the investors and us do 250k in the first round, and then 250k between us in the second round. So the company in total gets 250 from us. And then we also have the Development Bank of Wales Technology Seed Fund that our investors co-invest alongside with. They'll invest also in pre-revenue tech companies, and they'll also invest 10 million in any one company. They have the potential to do that. Again, that's dependent on milestones that the company and the technology ventures team have agreed with the company. So does that answer the question?
Yep, got a thumbs up there.
Thanks, Andrew. So any others? So Richard, what are the typical legal aspects in setting out the investors on board? So legal aspects can vary greatly. I know a lot of people use legals now, and that can reduce costs. I know some angels will say, well, we're building a syndicate, we're getting our own legal representation, and we're going to take the costs of that out of the round that's being raised. So you have to add that into the costs. Or you might have a subscription agreement that you get as a company, get the investors to on board with, and the investors just get their legal team to review it. So it could go from a couple of thousand up to 20,000 in the worst case scenario. So you need to be somewhere between 5 and 15 potentially, bearing in mind the costs for. The important thing is whoever you use, they're prepared to spend time with you to go through what these consents and rights mean. Alison. Yeah, so individuals can be a nightmare. I know, Alison, if you've got a cap table of a lot of small investors, it can be time consuming. So that's why we're really advocates of lead investors. So with Concentric Health, and we've got our lead investor, Ed, in there, he was the conduit. So with the company, he was the one speaking to them. He was the one speaking to the investors and rallying them round and getting the deal over the line. And he was responsible then for setting up, every 6 months, then doing a video call with all the investors to get their update with the company. And then the company could speak directly on that video call or face-to-face with the company. So ideally, you want a lead investor that's herding the sheep and communicating with them, so you make sure you get value out of them throughout. With our co-funds, we've got a company, one that went in the press was CoinCover. So we're here to support companies, and we want to help get new VCs on board. So we've had a partial exit already from that company to help bigger players come in and slim, make shares available. So yeah, it's ideally, as our network grows, more and more of our investors know each other and work together and work as a unit. But until you know who those investors are, you don't know how hard they are going to be to manage, which is why if you can set up data rooms straight away, if you can communicate, this is the process in terms of, here's the one pager, the first Thursday of every month, I'm going to be doing an update until the investment closes, or every 2 months, I'm going to be doing a review. Anybody can come on and catch up with us. Just try and centralize the communication rather than talking to investors on a one-to-one, and you get that inkling of who's often overseas and unreachable. Because when I do have my next round, I need to be on them before, because they may not be contactable. And I think WhatsApp has tended to prove to be the most successful form of communication for the most elusive investors, in my experience. So one more message from Andrew. Concentric health. Yeah, so if you know concentric health, probably have a good chat with Daff, who's got more insight than me at this stage now. But the complexity, like I said, we had Ed acting as a conduit, so he's pretty much managing the investors and giving Daff the time. So small amount of 500k is not actually that small given what they were able to do with it, and given the deal sizes we see. There's 24 investors in there, so if Concentric need a follow-on round, they're building really good relationships with those investors. It's actually not going to be that much work for them potentially to get another seed round closed quickly. So, and I know on the cap table that I've seen and the investors I've seen, they took from our co-fund, they could have taken 250k, but they actually took a lot less than 250k from us, because they recognise the value of all those individual investors we're going to bring. So they could have chosen to have less investors, and they chose to have more. And I think, Alison, yeah, you will have people that want to clean up the cap table. So yeah, again, I think I've covered those points. It's conversations to have with other, speak to other companies that have been through Series A and what their experience is of that. Angel investors will ask for preemption rights, so they will ask for rights to follow on, as they should, being backing you in the early stages. They should be there for the long game if they want to. But that's something you have to negotiate with them and with the Series A. If you've done well and you're going for Series A, some investors might be happy to come out at that exit. Not everybody wants to go for the end game, and that's, again, it's all about being aligned and having those conversations from the beginning. So Alison, is there a sweet spot for size and scale with your investors? Yeah, because our investors want to syndicate and want to do it smartly and hopefully over a period of years. They want to do it either in sectors they know or alongside people they trust. And as they're syndicating, it can be individual ticket sizes can be anywhere from 5, 10 to 50k. Even the most wealthy people that could actually do the round all by themselves without a flinch are syndicating at that cap of 50k, because they know the value of building a portfolio and getting other people in that have got that expertise to help the company. And sector-wise, we're sector agnostic, so we see investments across all sectors. One sector that seems to get interest across the board is medtech, because I think even if you haven't touched medtech, you can see the value it can bring, and investors want to do good. So we do quite often, you will see a lot of interest on the medtech companies, even if an investor hasn't got a clue, because they just want they want to see these companies get funded and see people receiving better healthcare. So that's the end of the online chat. If anyone wants to raise their hand, put their camera on, and ask me anything direct, feel free to do so.
Hi, Carol. Can you hear me? It's Richard.
Hi, Richard. Yes.
Yeah. A couple of different questions, actually. So, actually, it's one of the comments in the someone's asked as well, which was relevant. So, Mybus has been sort of running, well, fully trading for about a year now. So we're sort of quite early on, and it's all sort of self-financed by myself, and I'm sort of looking to try and sort of take it on to the next level, really. So, in terms of what we're doing with the company and the products and stuff. So at the moment, I'm not taking an income from it. So I basically got a day job, and then I run this on top of that, basically, and that's how I sort of envisaged doing it for the time being, because I was just trying to fuel everything into the business. Sort of obviously compromises my work-life balance, but just while we get it going and stuff. How would that be sort of viewed? Because realistically, if I was to try and take an income now, or with any investor money that came in the short term, it'd be impacting obviously the P&L of the business.
Yeah.
So really, I am compromising a bit my own time in terms of focus on the business, but it means I'm not then having to get a salary basically.
Yeah, that's a really good point, Richard. There's two main things there. One is investors love skin in the game. It's high risk. There's going to be low times. If you've put time and effort and your own cash into the company before you go to investors, they're going to believe you're in it as much as they are when the going gets tough and for the longevity. So, investors will see any kind of skin in the game as a massive tick. You've just got to balance that with, if I wait too long to go investment, am I going to be too slow compared to what others are doing out there in the market?
But in terms of that, them seeing me almost doing that as I've got another job effectively as well, wouldn't be perceived as a bad thing then, or not?
Not at this stage, not with the stage you've got yourself to. Once investment goes in, they will most likely say you've now got to be full-time in the business. And I don't know many investors that would put money into a business that didn't have a full-time founder in it.
Yeah. Okay. And then in terms of the actual, I think it was one of the questions that was asked actually, at what scale and at what stage, because obviously because I'm so early on, is that, and we've got a product out there, it's in Tim Morrison's, it's on Ocado, I've got wholesalers, etc. on board and stuff. So we're still, is it for me to, and I've been trying to thinking, well, I wanted to sort of get enough bigger fish on board to be able to show the credibility basically. And obviously helps the valuation as well. But is it for me to sort of keep plow, because I could feasibly plow on a bit further with my own cash flow and keep it going, or is it better to sort of do it now while I've got that? We're still at this sort of stage where there's, you can.
Yeah, well, there's two things. You've got the more you build it, the more evaluation you can put on it. But then you've also got the point of like, if it's really good and I've got enough to go for investment, I just want to get the investment, get the smart investors on and get them to help me grow, because there will be things that, you will want to bring other people on board, and you can't really do that without finance. You're always going to be limited if you don't get that capital with resources, aren't you? So if you've proven there's customers out there that want your service, and it's commercially viable and you've got that prototype, we are happy to start talking to you. And then you've just got to get a balance between valuation and what's practical for you to do.
Yeah. No, great. Well, I'll is it so? Just reach out to yourself then if we want to.
Yeah, so it's if Liz can give me your contact details after, I can just ping you across my template email that I send to everybody, and it's just like a checklist really. And then if you have a look at that, we can then schedule a catch-up call.
Perfect. Yeah. Okay. Thank you.
Thanks, Richard. And the only other thing I would add in terms of conversations around cap tables, Series A and funding journey and milestones is if you do know who your Series A target investors are, it does help. Most Series A VCs are looking for monthly recurring revenues of about 80 million or turnover, 80,000, sorry, and turnover of about $1 million. So when you're talking about, a lot of companies will fall into the trap saying, well, I'm not pre-revenue, I'm making sales. but they may be small in comparison to what's significant for a Series A investor. So the more you can identify those Series A investors and what KPIs they need, the better you are in terms of like saying, right, I'm ready to go for money. I need that money now to get to that stage.
And is it most of the investors, is it just purely investment they'll provide, or would they, because I know friends who've obviously done a similar thing, and there's part of that, they're getting some expertise because they might know that particular sector, or just more business sort of savvy stuff they can add to the business, which is
Absolutely.
not,
Yeah, not many investors I know just want to be cash. That they do, they are those people that have been there, done it as experienced entrepreneurs, and they want to give back. And they've sold their business, they've been forced into retirement, which is like the worst thing you can do to an entrepreneur. So they don't want to do a full-time job anymore, but they do want to be in the entrepreneurial world, and angel investing is the perfect fit for them. So they want to give back, they want to mentor, but they don't want a full-time, they don't really want a full-time job. So yes, it's the money, and the money is secondary really to the experience they can offer you.
Great, yeah. No, thank you. I'll let someone take over.
Thanks, Richard.
There's just another one that's come through from Alison on the chat. We're now at 350,000 recurring and 685 total. Should we be VC or another seed?
Yeah, I mean, it depends, what VCs you're talking to. I don't, I'm in the angel world, so I don't have a list of VCs and their investing criteria. I just know what from reports out there from like, PwC and KPMG, the sort of reports they put out there as a general rule, that's kind of the fit that most VCs look for. And it's even harder if you've got hardware. So software, it's easier because there's a lot more VCs out there, whereas hardware, a lot of VCs won't touch it. So it depends who you can identify. And, tax year end, there are a lot of funds out there that will put money in very quickly at tax year end. So timing is now. So if you're thinking about it in the next couple of months, in the next few weeks, and you're thinking, I know I'm not going to reach that million turnover in 6 months anyway, this year, this next couple of weeks is quite pivotal for a lot of companies deploying cash, and a lot of VCs deploying cash.
Carol, just a quick one from me, if you like. I was on the AGP program as an RM, so I had 53 companies I was looking after, if you like. Alison's being one, and Concentric being another. One of the things I find and still find is that there's a lot of uncertainty on the funding landscape. And these sort of sessions are great; they give you a high level flavour. But I sort of do think that if you could something like reach out, if you like, to those businesses and almost a couple of coaching sessions. This is the journey. Don't be afraid of it. There's nothing to lose by taking a deeper dive, if you like. I think that's probably missing at the moment.
Yeah, no, it's a good point, Andrew. And it's really hard because we will say to companies, you're going to be more compelling if you've understood the journey to exit. But how do you map it out? You're new to angel investing, you're new to VC investing. There's tons of VCs out there. How do you know which ones to go to? It's an awful lot of time you as a founder have got to put into this. So yeah, it's really hard. And then sometimes it's better to work backwards. If you're an angel investor and you can see there's appetite in the market for acquiring these companies, that may get your interest straight away. And if you can work back from that, but yeah, you can't outline it because it's too big. It's a big giant, but you can start appreciating the journey and the lines you're going down. And at some point, you can get the corporate finance houses involved to help you do that. But at seed round, hopefully you're not going to pay too much in terms of corporate finance because you can't afford to. Some startups will pay corporate finances for their valuation. It's like, but in all honesty, what do they mean to angel investors that are using their scorecard method and they're not really interested in discounted cash flows? So, at some point, you're going to need to get some experts on board. Yes, we can do more to outline the journey. And I know we've done some stuff internally with the companies that technology ventures teams work with. And the Scale Up Institute, I'm not as familiar with what they do, but Tech Nation, is there, is there some way we can join it all in and link them in? And, I'm subscribed to Bohurst, and you see new funds coming out all the time. So the moment you've got a handle on it, it's all out of date information. So we do have a startup in Wales that's trying to do some AI and good work on that, that's getting funding now. So, you know, as AI improves, you know, we will be able to get a better picture. But it's a big beast. So all we can ask is that you have an appreciation for it, and, you know, talk to as many people to get as much intelligence as you can.
Thank you.
Thanks, Carol. We've made you work for your money this afternoon on this one, I think.
Yeah, well, yeah, you know, I'm happy to help, and I'm happy to email what we need for the platform for anybody that's interested. And yeah, you know, fully appreciate it's really tough out there. But when you do win, it can be really exciting, and you know, it can be you know, being an entrepreneur does have its lows, but has massive highs. So you know, any support we can do, we're always happy to have a chat.
Fabulous. And I think if anyone has anything that comes up now after this and want to ask, then do they email you direct, or do they want to come through AGP and then?
Yeah, it's up to you what your process is. I'm happy for people to email me direct. It'll take me 2 seconds to email and my template email that they can run through, and then we can schedule a call from there once they've had a chance to think about that.
Brilliant. Okay, so if anyone thinks of anything further then that you wish you'd asked, then please get in touch with either of us there. I think our next fund in February is next Tuesday, so if you want to jump onto that one as well, I think that's about crowdfunding actually, so that might be the next one along. But yes, email. Yeah, somebody asked for a template earlier as well, I think, but we've lost in template for term sheets. So if we sort that out for James, but he's had to drop off there, so.
Oh, right, okay, yeah, I think there's lots on the internet, isn't there? And I know the only other thing I would add on term sheets is, you know, for seed stages, you're pretty simple. If somebody's putting some really complex terms in there, it's a bit of a red flag. So yeah, just and you know, set your own terms and give them to investors before they come in with theirs is something I would try and do.
Thanks, Carol, for giving up your time. Thank you, everyone, for joining us. Enjoy the lovely weather that's outside, and grab yourself a cuppa.